Good afternoon, everyone, and welcome to our June webinar. My name is Jonathan Howard. I'll be your host. This webinar is the first in a series we like to call the Summer Selling Series. And today's webinar is on offensive selling strategies. Our hosts today are Mr. Ken Shreve, he's our Senior Market Writer at IBD, and Mr. Justin Nielsen, who's our Market Research Director. Good afternoon, gentlemen.
Good afternoon. Hello, Jonathan.
There are really two schools of thought when it comes to selling. The first one is offensive sell rules, which is selling on the way up, or much more proactive selling. And the second is defensive sell signals, which is selling on the way down or reactive. So as I said, we're going to focus on the proactive selling on the way up, offensive sell signals. Before we get started, Justin, talk to us a little bit about the truth about selling.
Well, the truth about selling is it's hard. You know, a lot of times this is the thing that people have the most difficulty with. One of the reasons, I think, is because with buying, you have kind of that line in the sand, and it's very easy to say, okay, either it crosses that pivot point, that buy point, or it doesn't. With selling, you tend to get a lot of different signals, and for that reason, it can be very easy for emotions to come into play too, for two reasons. Number one, because it's not as cut and dry with that line in the sand, but also because you've made a decision. You're committed now to the stock. You've put money into it, and that does tend to cloud your reasoning sometimes with the emotions. You've got emotions like hope, fear, greed, pride. These are the things that are going to potentially cloud your decision-making, and that's why it's really important to have rules.
Okay, another truth about selling, again, we're never trying to sell right at the exact top. You know, when stocks topped in March 2000 and the NASDAQ hit an intraday high of 51.32 in March, we weren't telling people to get out of the market right there, but we were pretty close, you know, telling people to get out of the market in the early part of 2000. So we're not trying to sell right at the top, but we're learning to recognize sell signals when they arise to get you out close to a top, okay? And remember, you don't need, when you start to see signs that a stock is running out of steam, if you have conviction in the stock, if you might still be in the early stages of a bull market, maybe the middle stages, you don't need to sell your entire position. In some cases, you will. If it's a very severe weekly decline and there's just unequivocal sell signals, you may want to sell the entire position, but there will be plenty of other times where you may decide to sell a portion of it, maybe half or maybe even less than that. So it's pretty rare where you're going to be selling your entire position at once. That will be the case, but so that's another truth about selling. Okay.
Give us 1 second. Looks like things might be a little frozen. Let's read off here.
Okay. Another aspect of offensive selling, what we're going to cover today is basically 5 situations. We're going to talk about what it looks like when a stock makes a climax top. We're going to talk about what it looks like when a stock breaks.
All right, I apologize for that. We did have a strange power failure in our studio, but we are back. So let's go ahead and continue with the webinar. We're on slide 7, climax tops. We're going to talk about the first offensive sell signal and climax tops. Justin, talk to us about them.
Well, here's where emotions can really, especially steer you wrong. With a climax top, what you're seeing just a lot of euphoria. And climax tops have been around for a long time. This is not something that's actually just regulated to stocks even. The tulip bulb craze back in the 1600s in Holland, that's an example of a climactic run on tulip bulbs in that case. And what you're looking for is when a stock has, after a long advance, it starts to kind of change its trend and go more vertical. So when that stock becomes parabolic, that's where you can really get into a situation where people start abandoning all reason, and they'll just buy at any price. They're just almost desperate to get more shares of the stock. And what eventually happens is the stock will, run out of buyers. And once that happens, it can drop very fast and very hard. So if you can sell on the way up when you start recognizing the signs of a climax top, you're going to save yourself a lot of heartache. What makes it difficult, though, is when it's going up that much, it's the last thing that's on your mind is selling. You're thinking about, if I can just hold this for a little bit longer and get even bigger gains, that's where the hope comes in, and the greed, then, you're thinking you might be set for life. So it's very easy to recognize, but sometimes very difficult to act on because of those emotions. So let's go through the bullet points of the signals that you're going to be looking for. First of all, when you see a stock that's up 25 to 50% or more in 1 to 3 weeks, that's one of the things we're looking for. Now, where this happens matters. If it happens at the beginning of a move, that's strength and it's a positive. It's something we like to see as a stock breaks out and quickly makes progress. However, if this is something that is happening in a stock that's already made 100% run, or it's been running for a year already, then that makes us start thinking, okay, this could be a climax. You often will see the largest daily point gain, often an exhaustion gap, and keep in mind, gaps up are things that we like to see. That's showing extreme demand, a lot of power, but when it's at the end of a move, when it's a move that has occurred for a very long time and already gone up quite a bit, that exhaustion gap can be a signal of that last-ditch euphoric buying that's happening, and once that euphoria is, done and you run out of buyers, then it comes back to earth. Another thing we look at is when it's up a lot of days up in a row. Up 7 out of 8 days is one of the key things we look for. And also, just as a kind of a warning mechanism, if you see the stock get extended significantly above the 50-day or 200-day moving average, let's say it's 100% above the 200-day, that can let you know, hey, it might be time to start looking for a climax. We're not going to sell just because it's extended above the 200-day, but that can let us know, hey, this might be something that is going through a climax. So Ken, why don't you talk a little bit about this classic example, Qualcomm?
Yeah, we like to talk about Qualcomm a lot at our workshop because it really is a poster child of what a climax top looks like. So we just went over some of the characteristics to look for in a climax top, and Qualcomm topped in 2000 after a multi-year phenomenal run for technology stocks, 2,500% gain in 12 months. So you can see it's just a huge move that made a lot of people a lot of money. Down at the bottom of the chart, Qualcomm had been splitting its stock quite a bit. So we point out some excessive stock splits that can happen in the later stage of a stock's run. But you can see in the early stages, Qualcomm, it was using its 10-week moving average as a nice support level during its strong run. And then you can see we outlined an ascending base here that the stock broke out of. But once it broke out from there, it really started to run higher. You can see after the breakout from the ascending base, 2 really, really solid gains. Some people may have decided to hold there, especially after the stock traded tightly and just moved sideways for a period of a few weeks before breaking out again. But this is where we saw the widest weekly price spread up near the top, which was a sign that this stock was overheating. We didn't annotate this, but there was a time when an analyst came out and set that
$1,000
price
yeah.
target on Qualcomm.
This is before the 4-for-1 split, but yes, it was a $1,000 price target.
So it's just a classic example of how things were definitely getting euphoric around Qualcomm. So the lesson here is when you own a stock, and maybe it's not up 2,500%, or maybe it's not even up 400, 300%, but when you start to sense that euphoria is getting a little bit extreme around one of your holdings, it's never a bad time to start looking for sell signals like this. So after Qualcomm marked its widest weekly price spread up near its top, you can see the selling really started to pick up the pace, and it eventually gave up its 10-week moving average. We refer to the 10-week moving average is on a weekly chart, 50-day moving average is on a daily chart. So a lot of euphoria in Qualcomm in 2000, and just showed classic topping signals. And then the daily chart, which is just outlining a few more the things that we talked about. When it initially started to break out, it breakaway gap, an exhaustion gap, and then it broke out again, but really just started gapping up in price when it was already well extended from a proper buy point. You can see where the stock had moved considerably above its 200-day moving average. A general warning sign that we look for when a stock is 100% or more above its 200-day moving average, that's around the time where you want to just kind of start looking for sell signals and maybe think about taking some profits. Qualcomm actually moved 300% above its 200-day moving average. So again, just a classic topping signals here, and we had a lot of readers that were able to get out of this stock with still plenty of gains, even though it sold off sharply and continued lower for several months.
As a side note, one of the research items that I know we have a lot of model book stocks, and one of the things from those model books that we've learned is only 5% of our big winners ever get more than 200% above their 200-day moving average. Mm-hmm. So it's a pretty small number. So this was definitely in kind of the cream of the crop of the best winners in our model book stocks.
Yeah, it's actually also a very small number of stocks that actually go into these climax runs,
right.
Because you really need a monster stock market winner mm-hmm. to see these signs of a climax. A climax top is not going to come when the stock is up 25 or 30 or 50% from a buy point. You need a big explosive move, and Qualcomm certainly had it, and there are numerous other examples as well, but yeah. So
yeah, I mean, in this example, you were already up over 1,000%, and then it does another 100% on top of that, in just a couple weeks. So yeah, it was quite a run.
Let's go a little more recent. Justin, will you talk to us about Hansen?
So this was, it's funny because I was talking with someone in the office, and after all of the climaxes happened in 2000, we weren't seeing them anymore. And he's like, climaxes are dead. You just, it's not something we're going to see ever again. And I remember pointing this one out to him. It was Hansen Natural. They've changed their name to Monster now, which kind of makes sense because Monster Beverage was what was really driving this big move that it had. And I don't know if Monster is anything but natural, I suppose. But it had this phenomenal run, and here you got that climactic action. And I remember looking at this at the time. This was in May of 2006 that it occurred, and you get a lot of those classic signals. It was 151% above the 200-day line. That lets you know, hey, this might be a climax. You get exhaustion gap after exhaustion gap. The stock advanced 42% in 4 days. So again, just think of that emotional component here. You've got this stock that you're already up over 100% on. So it's probably a larger portion of your portfolio, and then it goes up 42% in 4 days. That's where you can get really suckered into, hey, I don't want to sell this thing. What if it goes up another 42% in the next 4 days? You just start dreaming of what that could do in terms of change of lifestyle. So it's very difficult. Actually, you know what? In looking at this, the stock was up 820% from the cup with handle breakout before it had that 42% run. So it's just one of those things that it's very difficult to put yourself in the right mindset to just, hey, I'm going to follow the rules.
When it's too good to be true, it probably is.
Yeah. That was also the largest point gain. And here's something else. Now, you notice a lot of times the stock will come down very quickly. So this was more than a 20% correction down to the 50-day moving average in under a month. So very quick. And this is another place where if you hadn't sold, this is why the offensive makes a big difference. Selling on the way up. If you hadn't sold, then you're probably saying, oh, I'm 20% off the high. I don't want to sell here. And you might have even gotten tricked because as the stock goes up, it looks like it's getting into new high ground, and it does, but this is kind of unusual. Climax tops usually take a while to consolidate their gains, kind of get over that euphoria, and as soon as this got into new high ground, it really dropped very hard and quickly found its way below the 200-day moving average. And that's pretty typical of what we see.
How about Ambarella, Ken?
Okay, well, with Ambarella, you see a breakout just under 80, signified by the dotted line there, and then you have 14 out of 17 days up. Okay, so as a shareholder, somebody long the stock, you're actually feeling very good about a really solid breakout. But once it's extended in price, up 14 out of 17 days, then you see the largest daily price gain, where the stock was up $6.66. So that's a sign right there. You know to look for the largest daily price gain. So that was your sign that the stock could be overheating. And then when it hit a high, I think what is that, Jonathan, 126 thereabouts?
128.06.
128. The stock had moved more than 100% above its 200-day moving average. So knowing these rules, you certainly had plenty of reason to at least take partial profits. After you determined that the stock was well extended above the 200-day moving average, Ambarella gaps down, suffers its biggest one-day point loss of $25 thereabouts. So, when Ambarella first started trading, obviously there was a lot of optimism about the company's technology and growth prospects, and that definitely factored into the stock. But it overheated like stocks can do, and once again showed some classic signs of a climax top.
So something more recent.
Yeah. So actually, this is in a very similar, same industry group. This is NVIDIA. Now, NVIDIA was one that caught our attention very early on as we were coming out of a correction in January of 2016. This is one of the first stocks that jumped onto the IBD 50. And not only did it jump on there, but it just stayed there for a very long time. In fact, I think it was up over 250% from the time that it appeared on the IBD 50 to the time that it exited in December. So it was on for 8 months at least. And it had a great story. It had a great story. And with everything that was going on with self-driving cars, NVIDIA was kind of at the forefront of a lot of that. Now, granted, they still get most of their revenue from gaming. That's where the bulk of their revenue is from. But they had this story, and that was really helping fuel a lot of these gains, and it started looking awfully climactic. And this is something that, Ken and I, as we're, writing the chart analysis for the paper and on the IBD 50 stocks and marking those up in leaderboard, that's something that we note when we see it. So it had these signs of a climactic run. It was up 10 days in a row. We were seeing exhaustion gaps. It was up significantly from the original base, and it didn't quite get above the 200-day by 100%. It got up 72%, which in this market was pretty extended. That was very unusual for that time frame. So this is something that we were calling as a climactic run during this point. Now, if you switch to the next chart, you can see that what ended up happening here is this is one of those very rare cases where it did end up going higher eventually. But if you had sold at that climactic action where it looked, to be that climax run, if you had sold there, you would have sidestepped about 5 to 6 months of dead money, where it was basically going flat. It crossed below its 50-day moving average. It wasn't making any progress for a while, and then just recently it kind of started coming on strong, and it's had a pretty big run here for the last few weeks. Although there was that reversal that, kind of looked a little funny to us. But, it might be still one to watch.
I think with NVIDIA, I just wanted to chime in. I probably get more questions about NVIDIA these days than any other stock, even Apple. Okay, people want to know, is there more money that can be made in NVIDIA? And, there's something that we haven't talked about yet, that fundamentals can look the best, at or near a stock's top. Now, NVIDIA is a tough company to bet against right now. You mentioned they still get about half of their revenue from gaming, but from artificial intelligence and self-driving cars and data centers, I mean, there still is a compelling growth story here. Technically, I mean, you're looking at several up weeks in a row after an earnings-inspired breakout. You mentioned that really ugly week a few weeks ago where it hit a high and then came all the way down. So the chart to me looks a little suspect here. However, if you start to see some tight sideways trading and the stock is stubborn about giving back gains, it could have more left. But it's it's a stock that's made a big move up to this point, and just wanted to mention that fundamentals looking really good at or near a top. That remains to be seen if it's the case with NVIDIA, but there were some big sellers in the stock just a few weeks ago.
Absolutely.
For sure.
Before we go on, I just want to address a quick question. Someone was asking for us to define exhaustion gap a little bit more clearly. If we go return to the previous slide, we'll just show you a quick example of that. As I mentioned in the beginning, gaps up are generally good things. It shows that there's a lot of demand. But after a stock has been moving up for a long period of time, when you start seeing these exhaustion gaps where it's after a big move, those gaps start becoming suspect. It's the fact that there's so much demand this late in the game, that's what makes us a little nervous. And so that's why we call it an exhaustion gap, is because you often see that when the buying is getting exhausted. It's kind of a final signal. So let's go ahead and move on to a similar topic here, the break above the upper channel.
We have one more climax topic.
Oh, that's right. Yeah, we do. That's true. We threw this in here because Wright Aeronautical, climax tops are not regulated to just internet names. This was back in 1928, and Wright Aeronautical. This was shortly after Lindbergh had done his flight across the Atlantic. They were coming up with all sorts of new routes to cross the Atlantic, and Wright Aeronautical was having a huge run because of that. Now, it had already had a big move, and then it goes through this climax top. 9 out of 10 days up, 63% in just a very short period of time. Exhaustion gaps, all of those telltale signs. 205% above the 200-day. So the point here is, yes, this is from 1928, and a lot of people sometimes are like, why do you look at historical stuff? That doesn't have any relevance to today. Absolutely it does. The stocks, the patterns, the charts, they look the same. As you go back to the stocks that are very old, the RCA radio in the 20s, and you name it. There's just the patterns repeat themselves over and over. It's just like the names get changed.
That's right.
Now we're going to transition to breaking above the upper channel line.
Okay, so break above an upper channel line. Channel lines, when a stock breaks out above an upper channel line, once again, you're dealing with a stock that has made an extended run for a long period of time. Okay, channel lines should be drawn on a weekly chart. Should connect 3 points along the stock's highs or peaks as it's moving up. You're not going to draw an upper channel line over a period of 1 or 2 or 3 weeks. That's too short a time. So you want to try to connect 3 highs over a period of at least 18 weeks. Okay. So breakouts above an upper channel line are once again reflective of climactic action and just giving you a sign that the stock is overheating and could be ready for a pullback. So we can transition to Access Health, and this was in 90, 94, 95, 96, but this is just a very crisp, clean channel line, okay? So you can see it was easily at least 18 weeks, and we're just connecting the recent highs of the stock. And as Access Health was moving higher and higher, you can see it never broke out over that upper channel line, but it did right at the top. It tried to break out briefly, cross that upper channel line immediately just before a market pullback. Okay, so that's Access Health, just a good example of what a clean upper channel line looks like and what a breakout over a channel line looks like.
And you know what, an interesting point about that is, it wasn't just 3 points that it hit, those peaks. It was more than 3 points. And when that happens, and it's over, even longer than 18 weeks, it just gives you a little bit more conviction that this is truly a trend that it's following. And so when it breaks above that, it's actually something that we pay a little bit more attention to when you hit more points and over a longer period of time.
Yeah.
So let's take a look at CINA. This is from 2011. Of course, CINA is something that we've been watching more recently, too, because of the strength in the Chinese internets. But this is back in 2011, and you can see that, here again we had a number of points get hit at the peaks. And just so you know, this is not something you're going to be drawing on every chart. Not every chart allows you to draw a trend line, a channel line on it like these. Sometimes there is no trend, but when you do see it, and as Ken pointed out, we're using weekly charts, logarithmic. It's usually better to use the logarithmic scale. When you see that, it lets you know, hey, this is following a trend, and getting above that lets you know it's getting maybe a little bit too euphoric. So CINA had all those classic signs as well, and once it did cross above that line, it quickly found its way back down below the 10-week moving average line and on its way to the 40-week.
Those are a couple of classics. Let's look at two more recent examples and how you can use trend lines to get out. First one's NVIDIA, our old friend.
Yeah, NVIDIA, which we just talked about, going into a climax top, and just another good example. Looks like we connected 3 points here. Again, the span was well over 18 weeks, and you can see right at the very end it tried to break out over that upper channel line and reversed in heavy volume. Now, did it flag a precipitous price decline after that? No, it wasn't a big drop, but it did start a period of sideways movement for the stock. It was a kind of a wide and loose consolidation that eventually yielded another breakout, but just the fact that it broke out over that upper channel line, for people with a big gain in the stock that are following these sell rules, it gave them time just to lock in a gain, whether it was a partial gain or a full gain. Okay, you were able to sidestep that sideways movement where the stock pulled back in price. And if you still like the name and still had conviction, you might have been buying when it broke out again.
One more recent name, AEIS.
Yes, this is a name that had been in the IBD 50 for quite some time. I remember marking this chart up and annotating it when it was on the top 10 in leaderboard. But again, just a nice classic channel line drawn here. If you're having problems drawing a channel line, if you're having problems connecting highs, it's not going to be a valid channel line. So you really want to make sure there's good symmetry to the line. You want to connect the recent highs in the stock, and we did that with Advanced Energy Industries. And again, just a breakout over a channel line that preceded a break below the 10-week moving average. So for those people out there with some big winners that they've been holding for several months, go to the weekly chart and see if you can any of your stocks you can draw a channel line for them and see how it goes.
And there are a few cases where something will break out above the channel line, and that might even start a climax run in it. And so this can, again, go hand in hand with climax run. So, be aware of both signals.
Our third offensive sell signal is light volume rebound rally. Walk us through this one.
So what happens a lot of times is, okay, maybe you've missed selling on the way up, and the stock comes down a bit. If you're seeing the stock come down and then rebound, which, in all likelihood, you've probably gotten into that emotional state where you're like, oh, I want to, try and get back up at the highs. I'm going to wait and see if this can recover. If you see it recovering, if you see it rebounding, then look to the volume. If that volume is light, the rally is suspect, plain and simple. And so what we're looking at is if the volume is below average daily volume, you're seeing a number of days, not just one day, but a number of days in the rally below average daily volume. If the volume is much lower than it was on the pullback, or if the volume was lower than you saw on previous rallies, these are all signs that this stock might be lacking the institutional buying. It might not be getting the support that it used to. It might not be getting the attention from the institutions that it used to. And if it's not getting the attention of the institutions, you've got to be asking yourself, what's going to drive this stock up further? So if you missed, selling on the way up, and it does come down, a rally that's happening, if there's no volume behind it, that can be one of your last chances to get out of the stock while it's rising.
Look at an example, Alliance Semiconductor.
So Alliance Semiconductor, now this is from 1996, or 95, excuse me. Now in 94, it broke out of this cup with handle, and it shows that it broke out at $7 or what have you. But there were a few splits, so that's been adjusted for those splits. So it wasn't actually $7. It was more like a stock in the 20s at that point. So it had already had this big run, and then it's very hard to see it on the weekly chart, but it comes down and then quickly goes back up on light volume. So let's go ahead and take a look at the daily, and it's a little bit more clear here. So you get this largest one-day point loss. So that's actually a sell signal by itself right there. But you get that large one-day point loss, and look at the way that it recovers. You can see at the bottom, we show that the volume dries up on the rally attempt. Day after day after day, it's just there's lower and lower volume as the stock is recovering. It recovers from 40 to about 48. That's a big move. That's a really big move, and no volume behind it. So it's not the institutions that are driving this up. This is just, again, very suspect. And it gets within a quarter of that old high, and then it rolls over and starts getting into more and more trouble. So again, if you didn't sell it on the way up, if you get that signal that it's pulled back, and it didn't even come all the way down to the 50-day, but that rally on lighter volume. And you might make excuses. You might say, oh, well, it was August, it's summer, people were on vacation, they were in the Hamptons, what have you. But you just try not to make too many excuses. When you see it, it's not a bad idea to take some off the table.
Second more recent example, here's Weibo.
Yeah, just speaking on these low-volume rallies before we start to Weibo, I know, Justin, you're looking for stocks every day for swing trader, and, in recent months, recent weeks, recent months, it's been, very difficult finding stocks that fit these volume parameters.
Yeah.
Even when you look at a daily chart of the NASDAQ, next time, viewers are looking at a daily chart for the NASDAQ, there's been some heavy volume selling in that index and some lower volume rallies just recently. So it's tricky. You always want to pay attention when you see whether it's an index or a stock. Heavy volume declines, lower volume rallies. That's always a yellow flag to consider. This is a very up-to-date chart on Weibo, which was in the news today. Apparently, the Chinese government wants them to stop their audio and streaming, which is a big part of their website. But you can see after Weibo gapped up in price, it showed several above-average volume declines, okay? Signs of institutional selling in the stock. Now, it's still holding above its 50-day moving average, but we annotated some low-volume rallies since then. So it remains to be seen if these China stocks have more left. There's still compelling fundamental stories for names like Weibo and Sina, NetEase, these companies with a big internet presence in China. I wanted just to talk about Weibo, and after it gapped up in price, I mean, there were definitely some signs of institutional selling in this stock that people that are currently long Weibo need to pay attention to. Now, clearly the line in the sand here is the 50-day moving average on the daily chart and the 10-week moving average on the weekly chart. But just wanted to point out Weibo that after that gap up, there was some heavy volume selling, followed up by some low volume buying. So does that mean you just sell and head for the exits? No, but you just kind of stick that in your arsenal and consider it and say, okay, I'm on the defense here.
All right, our fourth offensive sell signal is new price highs on low volume.
So this is very related. Again, what we're looking at is what's going on with the institutions. Are they involved in this stock? Are they buyers? So especially when a stock is making new highs. If you see it making new highs in light volume, and again, relative to average daily volume or the volume corresponding to recent price gains, if it's low volume, then it becomes suspect. Now, as a stock is making new highs, as a stock goes from 50 to 100, it's making new highs all along the way. Of course, not every day can be on higher volume, but what we're looking at here is especially, where this is especially dangerous is when it happens on a breakout. It's breaking out to new highs, and there's no volume behind it, or if you're seeing persistent new highs happening on low volume. It just suggests that there's a lack of institutional buying.
And how many low-volume breakouts have we seen recently?
That's been one of the absolutely. That's been one of the things that's been the trickiest part, and something that I feel like we've been hearing from subscribers for a while now, like all these low volume, and sometimes they work, and if you're not taking a flyer on it, then you're missing some big moves. But it's just looking historically, the volume is such a critical component, and if it's not there, it's suspect. Plain and simple.
Let's take an example.
Yeah, it's definitely what's made the market in recent months tricky.
Yeah.
Even when a stock is coming down to the 50-day moving average for the first time after a breakout, or coming down to the 10-week moving average, we want to see that conviction support, volume behind support, and even that it's tough to find. So, anyway, Chicago Mercantile Exchange. This was back in 2004, 2005, but just a classic example of a stock that was well extended in price, but it crossed the 200 level and started hitting new highs in very light volume. It was just a sign that buying demand was starting to shrivel. During its uptrend, when it was trading around 140, 150, 160, you saw several above average volume price gains there. So there were signs there that institutions were accumulating the stock, were supporting the stock. But then the institutional buying demand dried up when it went over that 225, 230 level, and look at what happened. It started to consolidate gains, broke below its 50-day moving average, started to rally back. More sellers in the stock, gives up the 50-day moving average again. So, new highs in light volume, just another way a stock tells you that it is potentially starting to run out of steam.
And this goes back to a point that you made at the very beginning, Ken, where if it doesn't have to be an all or nothing proposition for yourself. If you start seeing these new highs on low volume, maybe you take a little bit off the table and let it run if it can. And if it doesn't, then you might start getting into some more defensive selling, which we'll cover in another webinar.
How about a more recent example?
So this is Glaukos. Now, Glaukos is one that we actually put on leaderboard as it was coming out of this cup-with handle, and it broke out. So the way we handled this was we got a pretty quick 20% gain on this. And we're going to talk a little bit about that rule, but we saw this stock reverse, and that's actually one of the things that made us take it off leaderboard and just book that gain of 20%. But then, that was pretty negative action. That reversal happened on very high volume. But then look at how it rallies, and there were a couple good weeks of volume in there. But then as it got to new high ground, the volume just completely dried up. So while it was getting into new highs, it was tempting, based on the price action, to say, oh, you know what, maybe we were wrong. Maybe this is a stock that needs to go up more. But the fact that it had no volume behind it was one of the things that made us kind of, okay, you know what, we're okay with where we sold it, and it ended up, really not doing much after that and petering out and eventually going below its 50.
It was such a bearish week for the stock when it reversed off its high. I think it got up close to 50.
Yeah, let's take a look at the daily. It's going to be a little bit clearer on the daily. 52.49 right there.
Yeah, and then it eventually ended higher on the day, but there were, when even though it closed up for the day, I mean, there was very, very heavy volume, closed near the bottom half of its range. So, but after that, it pulled back a little bit, and then again, you just see just a low volume rally. So savvy investors knew that after that bearish reversal day and then the ensuing low volume gains, the stock was definitely not showing the price action that longs wanted to see. So again, a leaderboard name that we took a 20% gain on, and it ended up being the right decision. And
you know what? I'm actually, and now that I'm looking at the chart, I'm recalling a little bit more of the story behind it. I believe we took this off right before earnings.
Okay.
You know, we were discussing this. We had a good gain on it, and we were right around 20%.
Mm-hmm.
And that bearish day, that was on earnings.
Oh, I see.
You know,
Right.
You know, and we were kind of kicking ourselves a little bit. Oh man, you know, we missed out on this big gain. But then by the end of the day,
We were feeling pretty smart.
it did come all the way back down, and that just kind of speaks to how volatile earnings can be. And a lot of times, we're going to keep our gains when we can, and not risk them to a bad earnings call.
Speaking of keeping our gains, this is one of Bill's favorite rules: is sell stocks at 20-25%. Ken, walk us through this one.
Yeah, selling stocks at 20 to 25%. Well, our research over many decades of research shows that when a stock breaks out of a base, it typically is going to rally 20 to 25% before it starts to consolidate and form a new base. So knowing that, it just seemed like that 20 to 25% rule was a good rule to take a gain. At workshops, people have all kinds of tax questions, selling for, tax purposes, and another common question is, well, if you sell at 20 to 25%, isn't that going to keep you out of some really big market winners where you can get 100, 200, 400% gains? So with this rule, you always have to kind of look at it in terms of where you're at in a market rally. Right now, most people, general consensus says that the bull market started in March 2009, so we're many years into a bull market. Now, after a 20% pullback and you get a follow-through day and you get new institutional money coming in from the sidelines and you've got breakouts left and right in spades across many different industries, in the early stages of a bull market, you may be more patient if a stock rallies 20 to 25% a few weeks after a breakout. You can hold it for a longer period of time. But in a market like we're in right now, taking gains at 20 to 25% makes a lot of sense, and frankly, it makes sense taking gains at 10 or 15% in some cases. We've seen the volatile, we've seen some occasional volatile action where gains can disappear quickly. So this is a frustrating rule to follow sometimes, but you know what? Taking a gain at 20 to 25% and going out and looking for another stock to buy, that's there's nothing wrong with that strategy.
Well, and I think one of the things that I learned very early on working with Bill, in discussing my own portfolio with him at times, I quickly found out that a lot of times I was having conviction in too many stocks. I was thinking basically everything I touched was going to be gold. It was going to be a model book stock, and that's just not the case. Bill told me that he only expects 1 out of 10 of his to be, or 2 out of 10 of his trades to be those big winners. And I was treating everything like it was going to be a big winner. So once I started booking those profits, it just really helps keep your portfolio humming along. And and then when you do get that conviction in a stock, when you get the big gains very quickly, it makes it that much more special. So let's take a look at an example here with Activist. Now, Activist came out of this nice little flat base here. The buy point was 133.10, and it quickly made a 20% gain over a period of, let's say, 2 months. And at that point, you have a decision. Okay, I can take some off the table. I can take it all off the table and book that gain, or book the gain and see if it gives me another opportunity to buy it later. Maybe at bases. That happens a lot of times. It'll go through another base, and of course, bases are at least 7 weeks long. So what you're doing is you're basically booking that gain, sidestepping that 7 to 8 weeks of dead money, and then possibly re-entering the stock. So in the case of Activist, it went up a little bit more, not very much, but if you had booked that 20% gain, it went up a little bit more and then started a 3 weeks tight pattern. So this is an opportunity where you could have bought it back at the 3 weeks tight, or if you had held on to part of your shares, you could have rebought the ones that you sold when it crossed above that 3 weeks tight, and then it goes up another 20 to 25%. And at the gap up, which you might say, well, it looks so strong right now. Why would I sell at the gap up? You know, you don't have to sell at all. You know, you could sell a little bit and, you know, see what happens with the remaining shares. In this case, they, you know, go up a little bit more, but then you start coming down. Now, one of the big defensive selling rules that we use is crossing the 50-day moving average on high volume, which you see happening here. You know, if you looked at the weekly chart, you'd see a big spike in the weekly volume. If you look at when that sell signal occurred, it's basically at the same point where you would have gotten the 20 to 25% gain booked. So you're basically just getting that gain earlier and sidestepping about 4 to 5 weeks of, you know, getting out at the same period.
And you see this over and over and over again. That's why the rule exists.
That's one of the reasons why, you know, we've become believers in it. You know, you see it happen enough times, and it's like, oh, okay, yeah, that's why the rule is there.
Here's another one. Here's another big name, Priceline.
Beautiful cup with handle breakout here in 2012, early 2012. Yields a really solid gain, 25% gain when it was approaching the 700 level, and it continued higher from there, and then pulled back in price down to the 50-day moving average, rallied back, and then rolled over again. So, you know, taking the gain at 20 to 25%, you might have left a little bit of money on the table. But again, following rules is so important when you're investing in growth stocks. And again, taking that 20 to 25% gain in Priceline, nothing wrong with doing that. It rallied a little bit, but then price action really started to get choppy, a little bit wide and loose, and it was definitely showing signs that it was ready to start to correct in price, and that happened soon after.
And this was before I was actually on the leaderboard team, so you were here on the leaderboard team at this time. But one of the things I love that you guys did was you used a kind of alternative rule to get a little bit more juice out of this. And you know, it was on leaderboard, and rather than taking the 25% gain, you guys decided to keep it on for a little bit longer and use the 10-day moving average. And so you didn't take it off until it crossed the 10-day moving average, and that allowed you to get another 5–10% out of the trade and get you even closer to the top. Again, we don't need to get right at the top, but that was pretty darn good.
It was pretty close to the top when it gave up short-term support there.
And when it crossed the 10-day moving average, that's exactly where you guys took it off the leaderboard. So, you know, good call there.
Okay, we see the value of selling. Let's talk about how the Market Smith charts we have will help you sell.
Well, there's a few things that we've put on, and this is with the pattern recognition tool that is included in a lot of the Market Smith subscriptions. It's our premium product, and what the pattern recognition tool does is it marks up a lot of things for you, so you don't have to do these calculations yourself. In the last webinar, Arusha and I discussed some of the things that you have available to you with this pattern recognition, but what we're going to focus on right now is these colored boxes. So you see where the pivot point is, you know, the base, and that's marked up for you. You see the dashed line telling you exactly where the buy point is. That's marked up for you. So the first thing you see above that pivot point is a blue box. That identifies your 5% buy window, because remember, we don't want to be buying things beyond 5%. We don't want to be buying them extended. So it immediately identifies there's your 5% buy window, first in the blue. It also identifies a 5 to 8% loss. That's the pink below. So that lets you know, hey, this is where you're getting 5 to 8% below your pivot point, your buy point, the ideal buy point. So that is just visually alerting you to when you might be getting extended or when you might be needing to sell defensively because you need to protect your capital. And then, you know, what we've been talking about today, you know, selling at 20 to 25%, that's also identified for you with the green box at the top there. So let's take a look at how some of these charts would look, some recent examples that would have alerted you to that 20 to 25% gain.
Yeah, these Market Smith charts are really some of the most robust research tools out there. I haven't seen any charting service that comes close to what Market Smith offers, but this was a look at Intuitive Surgical, when it broke out from a cup with handle base, Justin mentioned these, the little shaded red and blue and green boxes here. It was a nice breakout for Intuitive Surgical. The blue box is highlighting the 5% buy zone, and then the green box is telling you where approximately that 20 to 25% gain would be. So, just a good visual of how you would have handled this stock. It rose 20 to 25% from the buy point. And again, if you were feeling good about the general market, maybe we were still in a market where there were no distribution days. A lot of leading growth stocks were breaking out and not showing anything in the way of sell signals. Taking half a gain at 20 to 25%. It was fine. You don't need to sell the full position. If you had conviction in the stock or still feeling good about the general market, sell half and let the rest of it ride. But you can see how Intuitive Surgical was riding that 10-day moving average higher, showing good short-term support, obviously holding comfortably above the 50-day moving average, which is the red line, but showing good support at the 10-day moving average, and then a break below that support level in heavy volume. If you still had decided to hold on to some of your position or all of it, would have been your sell signal there to when it broke the 10-day in heavy volume.
What about Paycom?
Well, Paycom, has been a mainstay in our growth screens. These providers of workforce management software. There are several of them out there that continue to do well amid explosive fundamentals. So I think Paycom is still in the IBD 50. I know it's been a sector leader for some time. But here you had a breakout from kind of a choppy consolidation. But again, a 25, quick 20 to 25% gain after the breakout, and just taking gains at 20 to 25%. Again, it's right around the time a stock is going to start to consolidate gains. Sometimes they're going to run up a little bit higher, but it's really a good rule to follow. But again, use that 20 to 25% rule you got to understand where you are in the bull market. When you're in the early stages of a bull market, sometimes it's going to pay to give these stocks room to work. If you're kind of in the later stages, we're kind of a long in the tooth bull market here, and everybody's waiting for the market to come in and pull back. It's not happening yet, but in the current market, waiting for a gain from a breakout to hit 20 to 25%, it's a little tougher to do that. So in some cases, we've been taking gains at 10%, 12, 15% sometimes.
And this is another example where the arrow is pointing at the take the 25% gain. If you had decided to hold on to it for a little bit longer, you got some more progress over the next couple weeks, but then the market got hit very hard. I'm guessing that's June 9th, where you see the stock Paycom get hit very hard, and you're right back down to the level that you were at where you would have taken the 25% gain.
Once again, over and over again.
Yeah, absolutely.
I think one of the biggest question I've received in the 20 years of working for this company is, where do I sell? Buying is easy, but no one really has sell rules. And this 25% gain, take gains at 20-25% really is something that everyone should use. And a lot of you have 15, 20, 30 stocks, and it's hard to keep track of them. So we're going to show you a quick way to make it a lot easier. MarketSmith makes it easier. So if you want to set an alert, Justin's going to walk you through how to do that.
Yeah, and the reality is we all get busy, and even if you're sitting in front of your computer trading the whole day, there's nothing that necessarily means you're going to be looking at the right stocks at the right time. So one of the things that I like to use a lot is alerts, because sometimes I just need something to grab my attention and tell me, hey, look at me, I might need a little bit of decision-making to happen here. So if you want to set alerts for stocks that you own, if it hits the 20 to 25% profit level, it's actually very easy. All you have to do is on MarketSmith, what you're going to do is you're going to just right-click, hover the mouse over the green area, because remember we identified that green box as the 20 to 25% profit. You hover over that, right-click, and a box will come up that says Set Alert. So you click on Set Alert, and this dialog box will come up, and it's pre-filled in with a 20% gain from the pivot point, the buy point, the ideal buy point. Now, you can change this if you want. You can say, oh, you know what, I got in a little bit late, so I'm going to take 20% from the level that I bought it at, or you can just leave it in there as is. You click done. That alert is going to go in. Once it hits that price level, once it gets above that price level, you're going to get an alert sent to your phone, your email, however you have it set up, and it just lets you know, hey, this did what I was looking for. Now it's time for me to make a decision. Do I sell this? Do I let it go a little bit longer? But at least you are aware as quickly as possible, so that if something changes, you're right there, making a decision in real time.
And that's just one of the alerts. You can set an alert on any price in MarketSmith. You can set an alert for 7-8% down. So when you walk away from your portfolio or visibility from your portfolio, you are protected. You can always know what's going on, and MarketSmith will help you do that.
And it's not only just for the stocks that you own to determine when to sell.
Excellent
it's, of
point.
course, when you're going to want to buy something, too. Oh, here's the pivot point. I've identified it. You can set an alert that lets you know when it crosses that buy point. So there's a lot of flexibility with how you use the alerts there.
So if anyone who is listening to the call is not a MarketSmith subscriber and you want to buy right and sell right, we have a 4-week offer for you. It's 4 weeks for $29.95, and that is at www.investors.com/ms4weeks to take advantage of that offer. We do have one more special offer. This is something we negotiated for. For the first 20 people who call in, well, we have the customer service department is still open. They're at 1-800-831-2525. And this offer is buy 1 month for $149 and get 1 month free. But with this one, we're going to throw in a complimentary copy of the top stocks of 2016. Tell us why that's valuable to our customers.
Well, I mentioned briefly, these model book stock books that we create, and it basically looks at the top performers of each market cycle, and that's basically what you're getting with this top stocks of 2016. Here were the big winners of 2016. Take a look at what they look like, because that's how you learn going forward. Because the stocks that are the big winners, those patterns repeat. So if you can kind of ingrain those in your mind, that's what I really suggest for people. Take a look at them, go over and over them, because it just trains your brain to recognize what they look like in the future. Now, we do annotate a few of the charts at the beginning, but we have a lot of them left open for you to annotate yourself and really mark up and see what you can learn from these.
We have time for a couple of questions. This is probably the most popular question. This is coming from Robert. When taking 20-25% gains, any guidelines of how much to take off the table? You sell all, a portion? If so, how much?
You know what, with most questions like this, when it has to do with portfolio management, my answer is almost always, it depends.
Mm-hmm.
It depends on what the market is doing. It depends on where you bought it. It depends on what your prospects for the stock. What are the earnings like for the stock? Is this a stock that is still accelerating its earnings, or are you starting to see a little bit of deceleration? How powerful are the earnings? If this is something that still has triple digit, that might suggest to me a stock that I have more conviction in, as opposed to something that is just barely making our 25% minimum criteria. Anything to add to that, Ken?
Not really. As a general rule of thumb, if I'm a little skittish, I'm never afraid to take half off the table. I don't remember the last time I took 25% or 75%. I think for me to keep it simple, I will. If I still want to hold on to a position, I'll just get rid of half of it. It might be 200 shares that goes down to 100 shares, or 300 shares down to 150 shares. So there's no one right answer, but just personally, like I said, if I'm not interested in holding a full position, I typically will take half off the table.
Yeah,
and the other half
I think it's a good rule of thumb.
Yeah.
One thing I did learn from Bill is if you find your position getting too small, it's usually better to just blow the whole thing out, because if you get to, let's say you've got a full position and then you're at about 20% or 15% of your full position, then it tends to drop off your radar. It tends to be an amount of money that you don't pay attention to as much. So he said he usually just gets rid of the whole thing once he gets to that low level, if he's made multiple sells on the way down.
This John from Wisconsin says, how do I set an alert on Apple? And we didn't explain that, we should have. It's the same idea, but you're going to control right-click to set the alert. Instead of just right-clicking, you're going to control right-click, and that'll be able to set the alert on the screen for any MarketSmith product.
One of the questions that I saw earlier, and I don't remember who it was from, but I saw you hovering around it. It was doesn't a lot of this just come down to discipline?
Yeah.
Yes, it does. And that's why rules are important. You have to come up with sell rules. A lot of people don't, and they just go by feel. And that's not a good way to trade.
And the truth is, the vast majority of investors out there are undisciplined. It's just a select group. I know a lot of IBD readers that are students of the market that might have been undisciplined for a while. They're reading how to make money in stocks. They're reading the paper. They're reading the stories in Investors Business Daily, and they've learned to become disciplined. Yes. But the fact is, the majority of investors out there are very undisciplined. They don't know when to sell.
Or they know the rules, but they don't follow them.
Right.
And that's just as bad, or even worse. Ignorance is one thing, but breaking the rules, you really have no idea.
Let's try and squeeze in two more. Here's Joe. Here's a good one. Hi guys. So now we know how to identify climax tops, but when do you recommend to start selling them?
Bill always believed selling on the way up was the way to go. So when he starts seeing those exhaustion gaps, when he starts seeing you can get that largest daily point gain, he starts selling a little bit on the way up. Now, granted, he also had a portfolio size that made it to where selling on the way up was a lot better for him. Selling into the people that were doing all that buying was advantageous for him. But at the very least, if you see a reversal, I would certainly, be a little bit more aggressive in taking your money off the table.
Yeah, and anytime, again, when a stock is extended in price and it starts gapping up after a considerable price run, I mean, that's another time where you need to say, okay, things are getting a little excessive, excessive speculation, excessive euphoria, whatever you want to call it. But when a stock starts gapping up when it's already extended in price, it's a good enough sell signal right there, or at least to trim your position.
And don't beat yourself up if it goes up more without you.
Mm-hmm.
In so many cases, you see it come right back down to your level within a matter of weeks or even days.
All right, we've hit our full hour. I want to thank Ken and Justin for taking the time. Hope you guys enjoyed. Once again, the 4-week offer for Marcus Smith, $29.95. Go to investors.com/MS4weeks. Or if you want to get the buy 1 month, get 1 month free, and the Top Stocks book, which is an $89 value for free, call 1-800-831-2525. Thank you, everyone, and have a nice day.